Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. It's Friday, it's just after 2, and that means it's time for the weekly markets review from the mid. Joining me, we have Bryan Joyce. He's a managing director of Nasdaq's Markets Intelligence Desk. Bryan, thank you so much for stepping in for Chris today, my partner in crime, and for joining me for Trade Talks. It's been quite a week in the markets. Lots of red on the tape, especially today.
Absolutely. Well, first of all, thank you for having me. It's a
it.
pleasure to be here. Very volatile week. We started on a very positive note on Monday, which is a little carryover, a little follow-through from last week's record-setting performance, where I think last week was the best weekly percentage gain for the major indices in 7 years. And then Monday we had the benefit of the G20, which initially seemed to resolve itself in an optimistic way, but the message was slow to come out of China, and then it seemed to conflict a little bit with what was coming out of what the U.S. administration was saying, and even a conflicting message by different parties within the United States,
Right.
Trump and Mnuchin. So
yeah. Well, let's talk about the jobs number that came out today. It did slow down, and I don't think that was unexpected. The unemployment rate, it remains at a multi-decade low. Why do you think we're seeing such a reaction in the markets? Is that kind of an oversight, and it's a continuation of what's happening with the Fed, interest rates, G20, trade talks, all of that?
Yeah, I think the jobs numbers were a little bit soft, but overall they've been very good. The rate, is, as you noted, is at historic lows. So I don't think today's reaction in the equity markets is based on that. I think, as you said, it is a continuation of what we're seeing. I think it's probably more of a concern with what's coming out this week with China, the uncertainty about how the next 90 days will go regarding progress on a trade deal, whether or not tariffs will in fact go up after those 90 days. I think the issues at hand there are very deep and structural. We're talking about IP piracy, technology transfer, state-run businesses. Getting meaningful changes in those areas, which is what the U.S. is looking for, is not something that we should expect to be resolved in days and weeks. Could take months and even longer. So I don't know if the expectations for resolution there is something that is credible in the near term.
All right, and how about the yield curve? I mean, we know the banks are getting beat up because of that. They've had a relatively tough year. Why is that so important to what we see in terms of reaction to the Treasury and fixed income markets and, of course, the equity markets?
Well, yeah, so the belly of the curve, where the 5-year is now shorter, the yields in the 5-year is shorter than the 2 and the 3, that has now inverted. If you look at the longer end of the curve, it is actually steepening. So there is some different messages maybe being sent to the markets there, but overall, it's a relatively flat curve. The 2-10s is about 14 basis points. It bottomed at 11 basis points. Certainly a problem for the banks. Historically, when the curve goes negative, recession oftentimes follows. The thing with that is usually there's quite a bit of a delay between when it goes negative and the recession that comes on, that follows. And usually the curve actually will go positive before that recession even takes place.
So the pattern that traders are seeing right now is very reminiscent of other cycles, and it predates the recession. Is that what the concern is, you think, out there?
Yeah, I mean, I think the concern really what's kind of what we've been seeing is just a reduced risk appetite. We have trade fears. We have a global slowdown, which has been taking place all throughout 2018. The U.S. is kind of on an island of its own, so to speak, where the economic data here are very good. We just came out with PMI numbers this week in the high 50s. The rest of the world is around 52. China's just barely over 50. Anything below 50 is contraction.
Right.
So I think that's the concern there. How long can the U.S. continue to go on, outperforming versus the rest of the world?
We're like the best house on a bad block.
Absolutely.
It sounds like. All right, let's wrap up here. Let's take a look at the trading week ahead. We have manufacturing data coming out, retail sales, which is going to be a pretty hot topic considering there's a lot of hope with consumer spending in the U.S. at least. We have the ECB press conference and the Brexit vote. That's a big deal, the Brexit vote. That's going to change a lot globally too.
Absolutely, and there's a chance that we could see the Brexit vote, which is scheduled for Tuesday, maybe get pushed out. And if that's the case, it's probably because the expectations are that it's not going to pass. And then a day or two after that, we have the ECB meeting where they're expected to pause on their asset purchases or put an end to the asset purchases. Be interesting to see if the vote doesn't pass or if it gets delayed, whether or not that forces the hand of the ECB to maybe be more dovish than what the markets would be expecting. But at the moment, the ECB is expected to halt their purchases and then follow that with some dovish rhetoric.
All right. Thank you so much for joining us today.
Thank you for having me.
And thank you for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.